You know, there are mornings when you check the markets, you see a little red, and you sort of shrug it off, right? Sip your coffee, go about your day.
Just noise.
Exactly, just noise. And then there are mornings like this. I opened my tracking app earlier. I was literally waiting for the kettle to boil, and I honestly thought my screen was broken.
Oh, I've had that feeling.
I tapped it a few times, thought
Okay.
surely this is a glitch. It just looked like a crime scene, all red.
It definitely wasn't a glitch. It's what we in the industry call a sea of red. And you're right, it's visceral when you see it. And while the entire market is bleeding, and we are definitely going to talk about the broader damage because it is significant, there is one specific asset just standing right at the epicenter of this whole explosion.
We are talking about XRP.
We are. If you're holding XRP or even just watching it from the sidelines with, a bucket of popcorn, the last 24 hours have been, well, historic.
Not in a good way.
Not in the way investors usually put in their scrapbooks, no.
Right. So that is our mission for this deep dive. We need to move beyond just staring at those scary red numbers. I want to understand what actually triggered this, who is hurting the most, because I saw a headline in our research about a treasury firm losing nearly $500 million that made my jaw hit the floor.
It's unbelievable.
And I want to know what the fear and greed index is telling us about where our collective heads are at right now.
It's a classic case of market psychology meeting, just brutal mechanics.
Yeah.
There's a lot to unpack here, from liquidation cascades, which we really need to define clearly, to some very, very strange institutional anomalies.
Okay, so let's start with that headline. How bad was the drop for XRP specifically? Because crash is a word that gets thrown around a lot, but this felt different.
It was severe. XRP actually led the losses on Thursday. We're not just talking about a standard correction or a dip. We saw a staggering 24% decline in just a 24-hour window.
24% in one day. That's a quarter of its value. Just gone overnight. That's not a dip, that's a cliff.
Exactly. And to put a price on it, the asset fell all the way down to $1.17. It briefly touched 128, which technical analysts were watching as a key support level.
A floor, right.
It's a sort of floor it was supposed to hold, yeah. But it just smashed right through it. That $1.17 mark is the lowest price XRP has seen since, November 2024.
Okay, so we're erasing months and months of gains. But I have to ask, because I know the whole market is down, was XRP just an outlier? Or was everyone taking a 24% hit?
That's the crucial context. While everyone took a hit, XRP was the statistical outlier in terms of severity. That 24% drop, it marked the steepest single-day drop among the top 100 cryptocurrencies by market cap.
It was leading the downward charge.
A leaderboard you do not want to be on top of.
Right. Now, usually when a price crashes, I assume everyone stops trading. You get scared, you freeze up, you hold your breath. But the data you shared shows something different about the volume.
It does. And this is where it gets fascinating from a technical standpoint. While the price was plummeting, the trading volume for XRP actually jumped 57%.
Wait, so more people were trading it?
Much more. The volume surpassed $11 billion. Now, you might think, oh, lots of trading. That means healthy interest, right?
Yeah, that would be my first thought. High volume sounds like a party.
In a bull market, yes. But when you see a 57% volume spike during a 24% price drop, that indicates capitulation.
Capitulation, that is a heavy word.
It basically means giving up. It signals panic selling. People aren't buying because they believe in the future. They're all rushing for the exits at the same time.
A crowded theater, someone yelled, "Fire!"
And the door is only so big. Everyone is trampling each other to get out. And that trampling mechanism has a name in crypto: liquidations.
Okay, let's unpack that. Liquidation. I feel like it's a term we hear constantly, but I want to make sure we really get the mechanics of it. When we say millions were liquidated, what is actually happening to a trader?
Right. So simply put, a liquidation happens when a trader is using leverage. They've borrowed money from an exchange to make a bigger bet than they could with their own cash.
So they're amplifying their bet. High risk, high reward.
Exactly. They can bet it goes up a long or down a short. But here's the trap. If the price moves too far against their bet, the value of their collateral, the money they actually put up, it drops below a required safety level. At that point, the exchange doesn't call them up and ask nicely for more cash. The exchange's computer automatically sells their position at the current market price to cover its loan.
So it's a forced sale. The trader has absolutely no choice in the matter.
None. It's the game over screen.
Yeah.
And in this specific crash, The sell-off triggered $47 million in liquidations just across XRP derivatives contracts.
47 million wiped out.
And here's the kicker. Nearly 44 million of that 47 million represented long positions.
Okay, let me make sure I have this right. A long position means they were betting the price would go up.
Correct. So you had almost $44 million worth of bets that XRP was going to climb. When it crashed, poof, those traders were liquidated. And remember what I said about forced selling?
The exchange sells their assets to cover the debt.
Right. So the price drops, which triggers a liquidation. The exchange automatically sells the asset. When you sell an asset, what does that do to the price?
It pushes it down even further.
Exactly, which then triggers the next guy's liquidation price, which forces another sale, which drops the price further.
It's a domino effect.
We call it a liquidation cascade.
Yeah.
And it's a huge reason why that drop was so steep, 24% so quickly. It just feeds on itself. The algorithm takes over and just flushes everything out.
It sounds incredibly violent. And just to zoom out for a second, this wasn't just an XRP problem, was it? The liquidation numbers for the whole market were even crazier.
Oh, absolutely. If you look at the total crypto market during the same period, total liquidations went over $1.4 billion.
1.4 billion. That is an enormous amount of wealth just evaporating from trader accounts in a single day.
It really highlights the leverage that was in the system. When the floor fell out, it fell out hard. And that brings us to the contagion, because XRP might have been the hottest part of the fire, but the smoke went everywhere.
Right. Let's talk about the other big players. Because looking at this damage report, it's not like Bitcoin or Ethereum were chilling on a beach somewhere. They got dragged down too.
It's a sea of red across the board. If we look at the heavy hitters, Bitcoin, it slipped below that psychological threshold of $65,000 on Thursday.
And that's a huge signal.
It's a major signal for the rest of the market. When Bitcoin catches a cold, everyone else gets the flu.
And Ethereum.
Ethereum fell to $1,800. It was down 6% on the day, which sounds almost manageable compared to XRP's 24%. But if you look at the weekly chart, it's lost 30% over the past week.
A third of its value. In a week. That is rough. I mean, imagine if a major stock like Apple or Microsoft lost 30% in a week. The news would be wall to wall.
It'd be the only thing on TV. And the altcoins took it hard too. Solana dropped to $85. That's an 8% daily drop, 27% weekly. BNB traded at $614, down 9% on the day, 23% on the week.
And I see Dogecoin here too. Looks like the meme coins weren't spared.
Not at all. Dogecoin declined to 9 cents. It shed 19% across the last 7 days. It's a total risk-off environment. Investors aren't moving money from risky coins to safe coins. They are moving money out of the ecosystem entirely.
It really does feel like a total market reset.
Yeah.
I was looking at the total market cap numbers you sent over. The sheer amount of money that has left the building it's mind-boggling.
It puts it all in perspective. The total crypto market cap fell 7.7% to $2.27 trillion. Now, $2.27 trillion is still a lot of money, but we have to compare that to where we were.
Right, remind us of the peak, because I feel like it wasn't that long ago we were popping champagne.
Just 5 months ago, September 2025, the market cap was peaking above $4.2 trillion.
Wow. So from 4.2 trillion down to 2.27 trillion. We've effectively cut the market almost in half in less than half a year.
That is the magnitude of value lost. It's not just a bad week. It's a massive contraction of the entire asset class over a very short time frame. Trillions of dollars in paper wealth have simply vanished.
So naturally, this leads to the question of how are we all feeling about this? I mean, I know how I felt looking at my phone, but is there a way to measure the collective mood of the market? Because feelings drive selling.
Right, absolutely do. And there is a metric we track called the Crypto Fear and Greed Index. It's a tool that analyzes volatility, momentum, social media. It tries to put a hard number on that soft sentiment.
And what's the number right now?
The current score is 11.
11. On a scale of what? 0 to 100?
0 to 100. A score of 11 puts us firmly in extreme fear territory.
11 sounds paralyzing.
It is. It indicates that investors are terrified. But what's really striking is how quickly this shifted. If we look back just last month, in January, the index peaked at 62.
62 would be greed, right?
Exactly. We were in greed territory. People were taking risks, buying the hype, afraid of missing out. In the span of a single month, we have swung from greed all the way down to extreme fear.
That is emotional whiplash.
It explains the sell-off. Market participants have completely shifted from that fear of missing out to just extreme risk reduction. They're cutting exposure as fast as they can because they don't trust the floor anymore.
Okay, so we have the panic, we have individual traders getting liquidated, but here is where it gets really interesting to me. It's not just the little guys getting hurt. You found a case study of a massive institutional player that is taking an absolute beating on this XRP drop.
This is a crucial part of the story. It's easy to think of crypto losses as, day traders on their phones.
Like,
Let's talk about Evernorth.
Evernorth, who are they? The name sounds very official.
It is. Evernorth is an XRP treasury firm. Their entire business model is built around holding this one asset. And they're backed by Ripple executives serving as strategic advisors.
So this isn't some random startup.
Not at all. This was a strategic launch back in October, with plans to raise over $1 billion specifically for XRP purchases.
So they are the definition of all in. They aren't hedging with Bitcoin or gold. They are an XRP vehicle.
Completely. They position themselves as a dedicated treasury for the asset.
Yeah.
And they put their money where their mouth is. In late October, they made a massive entry into the market. They purchased 388,710,631 XRP.
That is a lot of tokens. How much did that cost them in real dollars?
They spent $947 million.
Wow.
Nearly $1 billion deployed in late October.
Okay, so they bought almost $1 billion worth of XRP in October. We just discussed that XRP is at its lowest price since November 2024. I'm almost afraid to ask, what is that stash worth now?
Well, based on the recent prices during this crash, their holdings are currently valued at approximately $501 million.
Wait, they bought for $947. It's now worth $501.
Correct. That leaves them with an unrealized loss of $446 million.
They lost nearly $500 million in just 4 or 5 months.
On paper, yes. It's an unrealized loss because they haven't sold yet, at least as far as we know. But think about the irony here. A firm designed specifically to hold and treasure this asset has taken a 47% haircut on their initial investment almost immediately after launching.
That has to be devastating. I mean, usually in these situations, you hear the big funds say, we're doubling down, we're buying the dip. Have they said anything?
That's the other interesting data point. They haven't bought any more tokens since that first buy in October. And regarding the current market, silence. The company did not respond to requests for comment.
The silence speaks volumes, doesn't it? If you have $1 billion plan and you lose half your value out of the gate, it's hard to spin that.
It creates a very difficult narrative. It shows that even the players with the deepest pockets and the closest ties to the ecosystem, remember, backed by Ripple execs, are not immune to this volatility. It sort of levels the playing field in a brutal way.
If the insiders can lose $500 million, nobody is safe. But, and there's always a but in crypto, you pointed out this weird anomaly in the data. We have this crash, we have extreme fear, we have Evernorth losing hundreds of millions, but then there are the ETFs.
This is the paradox. You would expect, given everything we just discussed, that the U.S. spot ETFs for XRP would be seeing massive outflows, people dumping their shares.
Right. If the price crashes 24%, I assume people are selling the ETF to save what they have left.
But the data says the exact opposite. On Wednesday, the 7-spot XRP ETFs in the U.S. actually recorded $6.9 million in net inflows.
Wait, inflows, money coming in.
Yes, and with about $5.9 million in volume. So while the global price is collapsing and traders are getting liquidated, a specific group of U.S. investors is adding to their positions.
That is baffling. Why? Is that just the classic buy the dip mentality?
It certainly looks like it. It suggests a divergence in perspective. You have the global market panicking, and then you have maybe a different class of investor, maybe longer term, using the regulated ETF structure, who sees red numbers and thinks discount rather than disaster.
It implies some people still see long-term value. They are zigging while the world zags. Speaking of the long term, what about the leadership? What is Ripple Labs? What is Brad Garlinghouse saying about his token dropping 24%?
Well, he hasn't publicly addressed the bearish price action.
Not a word on the price.
Not directly. His focus has been entirely elsewhere. He's been talking a lot about efforts to advance the market structure bill through Congress.
So the house is burning down, and he's talking about architectural blueprints for the future.
In a way, yes, but it signals a strategy. When you're in a position of leadership like that, commenting on daily volatility, even severe volatility, can be a trap. If you acknowledge the crash, you validate the fear.
Ah, I see.
By focusing on regulation and that market structure bill, he's trying to signal that the long-term viability of the industry depends on laws and clarity, not on today's ticker price.
It's the keep your eyes on the horizon approach, even if the ship is rocking violently right now.
Exactly. He's betting that regulatory clarity will ultimately matter more than a week of extreme fear. He wants to change the conversation from price to policy.
Which is smart, but probably frustrating if you're holding a bag that's 24% lighter today. So let's try to summarize this wild ride. We have XRP taking a historic 24% dive, dragging the market down with it.
We have a liquidation cascade wiping out nearly $1.5 billion across the crypto space, essentially flushing all that leverage out of the system.
We have sentiment hitting rock bottom at extreme fear, and 11 out of 100 people are terrified.
And we have institutional giants like Evernorth sitting on nearly $500 million in paper losses, and they're staying completely silent.
While at the same time, U.S. ETF investors are quietly putting a few $1 million back into the pot, basically catching the falling knife.
It's a chaotic, contradictory picture.
It really emphasizes how quickly fortunes change here, going from a $4.2 trillion market to a $2.27 trillion market in 5 months is a sobering reality check on the nature of this asset class.
It certainly is. It makes you realize that volatility isn't just a buzzword, it's the defining feature, is the price of admission for this market.
Absolutely. So as we wrap up this deep dive, here's the thought I want to leave everyone with. We see the carnage, we see the losses, but we also see those tiny ETF inflows.
The contradiction.
Exactly. If a massive treasury firm like Evernorth, with all its insider backing and strategic advisors, isn't buying this dip, but retail investors and ETFs are, who is right? Is this the bottom where the opportunity lies? Or is the silence from the big money a sign that we haven't hit the bottom yet?
That is the $500 million question,
Yeah.
and usually the market answers it when you least expect it.
Thanks for listening to this deep dive. Stay curious, stay informed, and maybe check your portfolio a little less often this week. We'll catch you next time.